Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Jack Krupey. Thanks for being on the show, Jack.
Pleasure to be here.
Jack has been investing in real estate since 2001 and was part of a large PE fund purchasing distressed mortgages since the 2008 crisis. During that time, he was also personally investing as a limited partner in various syndication deals. He recently launched his own Reg D fund, the Diversified Real Estate Fund, focused on aggregating capital to provide investors a diversified investment into multiple syndications with a diverse portfolio of multifamily and various markets with a select group of experienced and well-qualified operators. Jack, thank you again for your time being on the show. I'm looking forward to getting into that in this model you've created, because I know it's something that I've heard people talk about a little bit, and I know there's listeners who are wondering how that works a little bit and just the fund-to-fund models. But give us a little bit about your background in real estate and getting into the fund type of business.
Sure. So I actually started in 2001, shortly after college, buying single family and small multifamily properties in Rochester, New York. Was there until the 2008 crash, and then during that time, I was able to land a job at a private equity fund that was buying large portfolios of distressed loans. They needed someone with real estate experience to handle the incoming short sales and just the other side of the business. So I was there for a few years, then launched my own small fund. Then we ended up partnering with a private equity group and bought over $2 billion in loans between 2015 and 2020. I actually still maintain a minority ownership in the platform, but I left in 2019. I'm more of an entrepreneurial guy. And then during that time, we bought over 30,000 loans, and I was personally investing in a number of syndication deals. And I just, there wasn't a lot of diversity of choice. I had a buddy that was doing deals in Charleston, South Carolina. So I had to choose between putting money. Do I put money in Charleston, South Carolina with one operator? Do I put money in Texas with another operator? And just me personally, I was looking for a little more diversity, and I didn't really see a lot of other options. So that led me to create the diversified fund.
Nice. Well, I'm looking forward to getting into that. Why don't we just talk a little bit about, and I'm sure you can speak to this very well, but just like some pros and cons of having a fund, versus being, investing in specific deals like you were talking about.
Sure. So, obviously with a specific deal, you get to dive in a little further and know exactly what you're getting into. You may have, more comfort level with, a personal relationship with a certain operator. So that's the main pro of doing a direct deal. Doing this fund of funds model, you're getting a diversity of operators. So if one operator runs into challenges, it's not going to take down the whole portfolio. You're also getting a diversity of markets. So far, and we opened the doors late September. We're in 3 deals already, just with my own personal seed money, as well as a few friends and family that came in. And so far, we're in a 104 unit in Augusta, Georgia. We're in a 266 unit in Jacksonville and a 286 unit in Phoenix. So if there's a hurricane in Florida, it's not going to affect Phoenix. If there's fires out on the West Coast, it's not going to affect Florida. And it is I think the diversity plays a key component of it. The other aspect is although we're charging our own management fees, even really, really strong, successful operators, when you have 45 days to raise $5 million for a building. Even guys with large databases and great investor bases are always looking for larger check sizes. And we often get better deals, better returns than if somebody were to put $50,000 directly into a project. So it may not offset every dollar of our management fees, but it's it can make a big difference whether we get a piece of the GP or whether we get a higher preferred return. There's a number of things we can do to offset to make it a better return for coming in through our aggregated capital than just going directly into a deal.
Yes, no, it's awesome. I mean, everybody talks about diversification, and this is a great way to diversify, like you said, amongst operators, but not only operators, but also markets as well. Tell me, what are some, some of the biggest concerns that investors have when investing in a fund like this?
Sure. Well, right now, in addition to just the fund itself, I mean, there's a lot of investors worried about just political risk, also with the COVID situation, and what happens when the government stimulus slows down. Those are generally the conversations we're having right now. I'm overall still very bullish on the residential sector. There's just not enough single family housing supply. Across the deals we're in, most of the operators are within 1% or 2% of rent collection that they were last year. So, and I don't, of the tenants that have reported COVID-related issues, just in this workforce housing sector, it's not that I don't believe the bottom's going to fall. It seems like a majority of people still have jobs, or they're essential workers, and they're not all only employed because of the PPP funds. I could certainly see a recession, or some struggles next year, but I just don't think this sector is going to get hit nearly as hard. If you're in our core is really, we're focusing on Class B multifamily. If things get tough, people are going to downgrade from Class A, or they're going to sell their house, and the single family market is booming. Any vacant properties, because of the foreclosure and eviction moratoriums, the exposure we still have to the single family foreclosure market is anything vacant is selling very, very quickly. So that lack of supply trickles down to the apartment sector, where if you can't find a house because there's multiple offers, you're gonna stay in apartments. There's some concern over potential capital gains tax changes depending on who wins, and I feel like that comes up in every election cycle, and I can't imagine a scenario where they just completely do away with it. I think cooler heads will prevail, even if in a Biden administration where the rate may go up a bit, but I just can't imagine they just eliminate capital gains completely. I think there's enough rich Democratic donors that own real estate as well, and I hope that some sense will prevail. Other questions are really just about about the operating partners. So at least at this stage, the partners we're in with, I've known for many years. I've had my personal money with them. The group in Augusta, Georgia, has also had done non-performing loans at some point in the past. So I actually knew them and did business with them both on the loan side, but the main owner also had multifamily the whole time as well. So these are long-term relationships that I'm leveraging for the access to at least the initial deals, and over time I'm hoping to continue to network and find other strong sponsors and strong markets.
Nice. So let's talk a little bit about just the relationship, say, with a sponsor while operating a fund versus just being a LP or limited partner.
Sure. So obviously, one of the benefits is a lot of the sponsors we talk to are going through hundreds of deals to find the good one. So it's making my life easier, because we're not competing in that way. We're not bidding against them for a deal in Atlanta or Charlotte. So as the LP capital, the good deals come to us. We're looking for strong operators that have the similar mindset to us for the types of asset classes, the types of value add, and really just a strong sense of ethics, ability to execute. I like operators that have been through a down cycle, whether it was in apartments or just have been around long enough to have been through the 2008 crisis, because we've seen things can go sideways, and really those are the key. There's some more logistical things, like making sure the K1s get out on time, so that we can take our K1s in, and just aligning on just the level of value add and the return metrics, so that we're because we're balancing multiple properties, some of which are heavier value add, some of which are a little more stabilized. So, we're trying to create a balanced portfolio where we're paying quarterly dividends, and that we don't have too many value adds at one time that hurt the dividends. But at the same time, we're trying to still provide a mid-teens return overall. So we want that balance.
Why don't you speak a little bit about creating a fund like this? I know there's probably many listeners who are contemplating creating a fund, especially right now. I've heard more talk about a fund, recently than ever, or than in a long time, I'll say. But there's just a lot of thought around. There's going to be deals to be had soon, and so let's obviously raise this money so we're prepared. But you can speak to just how you created this fund and some steps, or maybe things you wish you had known when you started to create the fund.
Sure. So, although I've been involved with billions of dollars of transactions, this is the first time I've actually done the Reg D. I always had, I had one big private equity backer and handled all the fundraising. So I chose to do the Reg D 506C because I wanted to be able to do some level of promotion and advertising. And I feel like a majority of the investors were going to be accredited anyway. So, it limits us to only accredited. And I just feel that's a safer way to go. I have multiple share classes. So there was the balance of keeping it really simple and doing whether it's a 70-30 or with a certain hurdle where the promote can go higher, or just doing a fixed return. And so I chose to do both. We have a fixed return share class that just provides 10% with a 3-year lockup. That in some cases could be better for IRA money. I can't give tax advice, but the way it's structured, it's minimizes UBIT if it's just the fixed return and you're not getting an equity. The leverage doesn't affect you as much. And then we have the 6 or an 8% preferred return with a 70-30 split. And that just the 8% just pays if someone's coming in with more than 250,000, they get a higher preferred return. So we tried to structure it so that it has both a fixed return for people who just want to clip a coupon, and then the more aggressive return for investors that are looking for the higher returns. Duration comes up a lot, and that's the other thing. For the fixed return, we could do a 3-year lockup, and then people can request their money back. But many of these deals will be into these deals for 5 to 7 years. So I'll tell people you're investing. It's a fund, but you're investing in a business. And the reason, if you want to have immediate liquidity, you could buy a REIT, but you're probably going to make a 6 or an 8% dividend on the REIT, and have the ups and downs of the stock market to contend with. And then you actually, it's not even a qualified dividend because the REITs aren't taxed at the corporate level first, so it's not even the discounted dividend tax. Versus this fund or any of the funds, you get the pass-through depreciation, which for high earning accredited investors, it's the pass-through depreciation is one of the key benefits. So I guess the main point is it's the balance of trying to keep it super simple, but also having a few different options for different types of investors.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. Nice. No, that's awesome. Investors love to have some options depending on what their investment goals are, right? Whether it's growth, right? Long term, or they need more cash flow now. And like you said, even whether they're investing with an IRA or something else, it may be more beneficial to do one way or the other. But a couple of things you mentioned there that I don't hear very often. You said, an investor that's investing $250,000 or more, they can make a little higher return. Right. Could you just elaborate on that a little bit? It's not something I don't see many deals structured that way. That I think it's neat to encourage those that can to invest more. Just speak to that a little bit.
Yeah. I mean, it's an incentive. Obviously, as a newer fund, it's an incentive to get a little more money in the door. And I think generally people that have more capital tend, in some cases, do have more options as well. There's a fair amount of credit investors that don't have any exposure to this space. So, but then there's others that might have a choice between doing a direct syndication or coming into the fund. So it's just trying to provide a reasonable incentive to the higher net worth investors that can come in with a bigger check and make it competitive against other options. And we do have an advisory practice as well. So for select situations, we may have the opportunity for investors to also invest directly into deals alongside us as well as part of a sidecar fund. We're not going to turn into a CrowdStreet or a Fundrise ourselves. I think we're going to stay more boutique, but there could be situations where the fund is only going to invest a certain amount of the fund's capital in a deal, and a sponsor that we are close with has more capital needs than we want to allocate ourselves. So there could be some individual one-off situations as well, and those are customized deals we can put together for the higher net worth investors. We also can facilitate or discuss 1031 exchange options. Someone owns a building and is looking to do a tenant in common situation, and they have probably needs to be a 7-figure deal to make sense to do all the legal. But we've seen situations where you set up a Delaware trust and set up a tenant in common situation, and those are, because we have so many operators that own, a lot of them own 10, 20 other buildings besides the ones that were even invested with them. There's going to be the ability to do off-market transactions as they figure out which buildings they've owned for 4 or 5 years that they may want to sell or recapitalize. So it just opens the door for just various opportunities. And real estate's a team sport. So
for sure, yeah. And one thing quickly, I know you mentioned like a 3-year lockup in a fund, where like they can't get their funds, they can request their funds after 3 years. Could you elaborate on that a little bit? Because I know that's always a question, right? When do I get my funds back? And if it's a single, deal or syndication, then obviously, it's very difficult to do that until we exit, right? But how does that work with the fund?
Sure. So that part is more of an open-ended vehicle. So it's preferred equity. So you still have membership interest in the LLC. You're fully secured. You're paid. Your preferred returns are paid pari passu along with the other share classes. But after the 3-year period, if you want your funds back, you can request them back, and that's sort of a more of an open-ended fund. So we can continue to raise fixed return equity and return capital for those that want out. They also may be able to convert into the longer term equity if they choose at that point, because we're targeting at this point the deals we're in have a pro forma 16.5 return between the 3 deals so far, and the fund's gross returns for the equity shareholders should be in the mid-teens or better. So those that want the cash out or short term, we'll just be continuing to raise fixed return capital. The fund does have a slightly broader mandate than just multifamily. My target is at least 50% of the deals are going to be these cookie cutter Class B value adds, which I think is a very defensive and safe haven asset class where you're forcing appreciation. But we have the ability to do bridge lending, mezz. We may make a small allocation into a senior housing development. So it's not it's multifamily focused for a core of the fund, but then there's a few opportunistic opportunities that could generate higher returns as well. And as we build a base of investors, I know a number of groups that have done, they only pay fixed return and don't actually share the upside. So I want to give both options to people, but we do expect that there's enough interest in people who want to clip coupons that that's going to be more of the open-ended fund, and then the equity side will be we'll probably launch a new fund every 2 or 3 years, just because it becomes unfair to the equity investors if you're continually taking equity. Sure. If it's 3 years in and you put in equity and then you sell a building 6 months later, it becomes it starts becoming unfair to the early investors if you take equity forever. But the fixed return side isn't affected by that, so it allows us to keep that part of the fund open longer.
When operating a fund, how do you prepare for a downturn?
We're very, one of the reasons we're in this type of asset class is I feel that it's probably the most immune to a downturn. We're certainly not going to be buying retail or office at this point. And my background in distressed debt, I expect is going to be very helpful when there is an inevitable downturn. Banks, in many cases, are forced to sell loans because the capital reserve requirements that they're required to maintain. Sometimes it makes more sense for them to sell a loan at 50%, 60% of the current asset value. So, we could kind of play both sides of the equation. Locking in very low interest rate exposure to a Class B multifamily, I feel is defensive. And then if and when there's a more significant decline, or even on the Class B, which I feel it's defensive, but some people might have bought with a bad bridge loan and just couldn't execute on their game plan. So if and when there's a project that's not going well, we're going to be positioned to bail projects out if needed, and work with one of the sponsors that we know is a great executor, and take over a building that maybe went a little bit sideways and needs a new management team in place. So I think you have to be prepared to pounce on the distress, but at the same time, I go back to value investing class. I took a updated value investing class in business school, and they talk about dollar cost averaging. If you were putting money into the stock market in 1929, 1 month at a time, the 6 months before and the 6 months after 1929, you would have been positive within 2.5 or 3 years. And there's similar statistics for the 2008 crash in the stock market. I look at that in real estate as well. Even if there is an expansion of cap rates, and even if multifamily does decline a few points, we're in cash flow positive projects, and we're going to continue to allocate money into deals over the course of a few years. And we don't need to time the market perfectly, but if there is a decline, we'll be averaging in, and it's not going to hurt the fund's returns.
Yeah. Well, on that note, maybe you can speak to just how you see the market adapting, post COVID, or what you see over the next 6 to 12 months in the real estate market.
Sure. So, I think it's definitely, increased the timing of people moving out of New York and California into secondary and tertiary markets. I don't think that office work is dead by any means, but I think a higher percentage of people are going to be able to continue to work from home, whether that's 5, 10, 20% more. And, that's more people that are going to be able to work from secondary markets for a much lower cost of living. So, I like the Augusta, Georgia over Atlanta, where you can get a point higher cap rate. The Jacksonville deal we're in, I had there's a stat that we pulled that had it's the highest net population increase post COVID was Jacksonville, Florida. And, I think it really bodes well for secondary and tertiary markets that have slightly higher cap rates. It's not to say we wouldn't do a deal in Atlanta, but those are uber competitive. And, the remote work, it's expanding on trends that were already happening. People were already leaving California for Phoenix and Las Vegas. Now, Las Vegas obviously has its own challenges with the tourism and the gambling industry, but, Phoenix, really, everywhere that people from California move, people from California were also moving to Boise, and various other markets, Texas. So, I think, it's just expanding on trends that were already happening. Interest rates are likely to be low for the foreseeable future, and locking in these Fannie or HUD loans where you're getting a sub 3% rate for either 30 years on the HUD product, or the Fannie Mae loan in Augusta. They did the green program, and the 12-year term, 7 years interest only at 2.88%. It's difficult to beat that financing, which will be in place for the length of the project, the length of time we're going to own the project.
So, Jack, just a few last questions quickly. I believe anyone that has a high level of self-discipline, or anyone that's successful in business has a high level of self-discipline. How did you gain such a high level of self-discipline?
Oh, it's sometimes it varies. I know I have it, but it's not all the time for everyone as well. I've always been driven. I've always been sort of a deal junkie, and a bit of a tax nerd too. One of the reasons I actually relocated to Puerto Rico. So I still keep an apartment in New Jersey, but I moved to Puerto Rico for the Act 2022 tax benefits. And I think it's a matter of just doing what you like to do. And I realize I'm not a guy who's going to swing a hammer and enjoy it. I know I'm not that guy, but I've always been the guy that's been a bit of an evangelist for real estate. In my 20s, I was the guy saying buy a 2-family house, live in the other half of it. And then I was early in the distressed debt, non-performing loan space, which really became its own industry in itself. A lot of real estate investors migrated into buying NPL in 2008, 2009. And now I'm really just an evangelist. I'm in my 40s now, and I've got, a base of friends, business partners, clients that are, have started to, build a bit of a net worth and are looking for ways to do it. It's really, more of a guide and evangelist for being a wealth manager and finding more efficient ways to deploy capital so you can make a mid-teens tax efficient return. So the answer is just, you got to do what you love. And I've had brief periods of time in my career where I wasn't doing what I loved and was sort of just in it for the money or just to get paid. And if you find your skill set where you actually enjoy what you do, it doesn't feel like work, and that makes it easy to just stay driven and just keep producing. What's
your best source for meeting new investors right now?
Right now, it's been just putting myself back out there. I had a bit of a database of people I've done business with, whether I sold them REOs or loans. So it's more of an active base. With COVID, it's not been as easy to do face-to-face conferences. But one of my colleagues did a virtual conference last week. I've been speaking on podcasts and just really putting myself out there. And it's doing various Zooms. I'm losing my voice in some cases because I'm on the phone 5 or 6 hours a day or on Zoom calls. So. It's just casting a wide net and just being willing to have a conversation. And what's great is for me it's a two-sided market. I want to talk to operators and sponsors. I want to talk to brokers, and I want to talk to accredited investors as well. So it's not every conversation is different. You never know where it leads.
What's the number one thing that's contributed to your success?
I think it's really that I'm kind of a shameless self-promoter without being excessive. I think people sense the passion and sense that I love what I do. And I'm just always interested in finding deals and opportunities and very generous with leads and referrals myself too. I look at it, how do you create a win-win? And I have that, I joke, it's like an idiot savant memory where like, I'll somehow remember a random fact about somebody I met 3 years ago and be like, oh, you should talk to that guy about this. So I really try to give back to and help connect people, and that's paid a lot of dividends for me over my career.
How do you like to give back?
I think just time, knowledge, time, information. I always am happy to talk with newer investors too and provide guidance. I'm just relocating to Puerto Rico. There's some organizations like the Act 20 Society that actually donates to various charities down here. And but with what my skill set is, I feel like the best thing to do is actually just help newer investors get into the space and make connections and just grow the community.
Nice. Jack, I'm grateful to have met you and have you on the show. It's just great to hear more about just the fund-to-fund type of model. I know that's becoming more popular and a lot of people have questions about it, and you'll be a great resource, I know, for many that are looking or considering that type of model. And maybe as a passive investor, being able to diversify a little more, in a couple different ways there that are important, but then also as a sponsor, it's neat to know people like yourself that are doing that. Tell the listeners how they can get in touch with you and learn more about you.
Sure. So we're on all social media. It's JKAM Investments. It's JKAMinvestments.com. And I'm active on Facebook as well as LinkedIn. We have company page, personal page, and the contact information is on the website. Please feel free to reach out through any of the social media. I'm sure we'll put it all in the show notes as well. And really looking forward to networking more with the community.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.